Dissolution of partnership firm. Dissolution of partnership and dissolution of partnership firm sometimes look very similar, as in accounting sense these two are very different. We say there is a dissolution of partnership when a new partner is admitted, or a partner retires, or there is a death of a partner. The constitution of the partnership changes. Even during the change in profit ratio, we say it is dissolution of partnership. Business, however, continues. And in case of dissolution of partnership firm, the business is closed. This may also happen on retirement or a death of a partner. So in nutshell, when the business is closed, we call it dissolution of partnership firm, and in case the business is continued and there is a temporary breakdown in the relationship or in the agreement, we call it dissolution of partnership. There are various modes of dissolution of partnership firm. A firm may be dissolved by agreement. When all the partners agree, it can be dissolved. By notice, in case a partnership is at will, that means the time of the partnership is not designed, it can be dissolved by giving notice. Any partner can give a notice and it can stand dissolved. And contingency, when all the partners become insolvent, or the term of partnership has expired, or sometimes the compulsory dissolution is there when the business become illegal. The court can also pass an order for dissolution of partnership. There are various grounds on the basis of which the court can pass an order. Any partner can go to the court if other partners are they are disobeying the terms of the agreement, or they are doing certain acts which are against the interest of the firm. The court can pass an order for dissolution of partnership. When a partnership firm is dissolved, the assets are disposed of and the liabilities and other dues are paid in this order. First of all, the expenses of dissolution are to be paid, and thereafter outsider liabilities, partner's loan, if any, and finally capital and current account of the partners. Now let us proceed with the accounting procedure. In order to close the books of the firm, the following accounts are prepared. A realization account. This is the basic account. This account is prepared to close the assets, liabilities, and also to record the sale of assets, payment of liabilities, and expenses of realization, that is sale of assets. Partner loan at number 2, that is after selling the assets and payment of outside liabilities, the loan is to be paid. The double entry is completed and partners' capital accounts are prepared. These are personal accounts, basically prepared to find out how much balance is due to the partner or it is due from the partner. And finally, the cash and bank account, the balances are closed. The main account is realization account. Let us proceed to see how entries are made in the realization account. This is the major account, and this account, as I told you earlier, is prepared to close the assets. The assets are closed by putting on the debit side. All assets have debit balance. These are closed by crediting, and the realization account is debited. Outside liabilities, they have credit balance, and these are closed by debiting outside liabilities and crediting realization account. These are outside liabilities. You will see these in the balance sheet. Bills payable, creditor, bank loan, expenses outstanding, provident fund, and even wife's loan is treated as an outside liability. The provisions also have credit balance. These may appear either on the liability side or may also be there on the asset side, like provision for doubtful debts. These are closed debiting provisions and credited relation accounts. These are provisions. Provision for doubtful debts, provision for depreciation, investment fluctuation fund, and joint life policy. Now, after closing assets and liabilities, we proceed to dispose of the assets. When an asset is sold, bank account debit, relation account credit, and if an asset is taken over, partner's capital account debit. Now the liabilities are paid. Payment of liabilities, the net amount paid is recorded, relation to bank, and if it is paid by a partner, relation expenses, and closing relation account, there is a profit divided in the old ratio and transferred to the capital current account or capital accounts. And if there is a loss, the reverse entry is passed. This was the structure of relation account. Now let us proceed step by step how the journal entries are to be passed. From closing assets, as already appearing in the balance sheet, the assets are closed by debiting relation account and crediting asset accounts. These are closed at the respective book values. The following items as appearing on the asset side are not closed. Cash and bank balance, because it will go into the cash and bank balance. We have a separate bank account or a cash account to be prepared, and this is a balance to be brought down in that account. Profit and loss account, loss, that is a debit balance appearing on the asset side. This will be distributed in the old ratio. Capital accounts, current account balance, if given on the asset side, these are debit balances and transferred into the capital account on the debit side as balance brought down. Proceeding further, the liabilities as appearing on the liability side are closed. Respective liability account debit to relation account. These are outside liabilities I already mentioned. Bills payable, creditors, bank loan, expenses outstanding, employees provident fund, wife's loans, and employee saving account. Provisions are also closed, debiting the provisions for doubtful debts, provision for depreciation, investment fluctuation fund, joint life policy reserve, and to relation account. Now disposal of assets. Assets sold for cash, bank account debit to relation account. If taken over by partner, partner's capital account to relation account. And taken over by creditor in settlement of his debt. Now this is a cross entry. Liabilities are already closed, assets are closed. And if an asset is taken over by a creditor, there is no entry in the books of accounts. After disposing of the assets, the liabilities are to be paid. Here we are making a relation account as a consolidated statement. However, in actual practice, the assets are sold in parts, and accordingly the liabilities are also paid in part. But let us keep it simple. Suppose all the assets have been sold, and the liabilities as and when they are paid will be recorded in relation account, paid in cash. Realization account will be debited and bank account credited. Notice that the actual amount paid is recorded. Similarly, as the assets were sold, at whatever price they were sold, they are recorded at the sale price. And if a liability is paid by a partner, realization account debited to partner's capital account. Note that all outsider liabilities must be paid, including contingent and unrecorded liabilities. Contingent and unrecorded liabilities are those liabilities which are not there in balance sheet, but at the time of dissolution, these are required to be paid. For expenses of dissolution, realization account debit to bank, and commission remuneration. Sometimes a partner at the time of dissolution is allowed a special remuneration for his efforts in disposing of the assets or payment of liabilities. Realization account will be debited and partner's capital account credited. Now, closing the realization account, there is a profit in case the credit side is greater and the debit side is less. The profit is transferred to the capital accounts in the old ratio, and in case of loss, the reverse entry is passed. Treatment of partner's loan as already appearing in the balance sheet. In case a partner has lent money to the firm, it is to be directly paid, and the entry for this is partner's loan account debit to bank. Note that if interest on loan is to be paid, it is an expense for the business, and the entry for interest on loan is realization to bank account. So we noticed when the capital accounts are closed, if there is a credit balance in the capital accounts, it is to be paid, and the entry is partner's capital account to bank. However, if there is a debit balance, the partner will have to bring cash into the business, and the entry is bank account debit to partner's capital account. So I hope you were able to understand the process of closing the accounts of partnership firm. So as an assignment, I expect you all to go through the slides once again and practice the illustrations right from the beginning till 5. We will proceed with lecture 2 once these 5 exercise questions are done. Thank you.